Strong but uneven growth, sticky inflation, and an emerging oil squeeze are pulling asset classes in different directions. Welcome to vTalkInsight, Allocator's Lens Daily for June 5th, 2026. Today we look at how an AI-driven capital expenditure boom, rising energy risks, and shifting central bank paths are reshaping the balance between equities, rates, credit, currencies, and commodities. We begin with global equities, where that AI investment wave is most visible in prices and flows. In equities, the central story is still AI-driven capital expenditure powering earnings and keeping indices near recent highs, even as volatility at the single stock level is picking up. Corporate AI and data center spending is now approaching a few percent of U.S. GDP, with multi-year investment plans for new sites, optical networking, and power-hungry infrastructure. That surge in spending is showing up in profits. Corporate earnings as a share of GDP are at record levels, led by technology, but with momentum now broadening across most S&P sectors and internationally. Flows into U.S. equities remain persistent, and investors are extending interest into areas like defense, economic security, and markets outside the large-cap U.S. growth complex. At the same time, leadership is quietly rotating. After a powerful run in semiconductors and cybersecurity names, there's been a move into financials, industrials, discretionary and healthcare, and even a tilt toward European equities after they lagged the AI rally. Recent disappointments from high-profile chipmakers, where single guidance erased double-digit percentages of market cap, underline how little room for error is left at elevated valuations. The IPO calendar around AI and space names adds another layer of tension. Some planned listings carry trillion-dollar-style valuations, tiny free floats, and fast index inclusion, which could create initial demand squeezes but also raise medium-term supply and valuation risk. Against the backdrop of rare index gains and a rally that has persisted without the Fed cutting rates, allocators are weighing bubble concerns against the idea that markets can continue to climb a wall of worry. The key watch points are AI-related earnings revisions, the pricing of upcoming IPOs, and whether energy or rate shocks finally interrupt the melt-up. Rates markets are caught between strong nominal growth and increasingly sticky inflation. U.S. GDP is expected to grow around 5% in nominal terms, with real growth a little above 2% over the next year, powered by AI investment, reshoring, and fiscal support. Yet both headline and core inflation are projected to stay above 3%, and the AI build-out itself is adding near-term pressure through heavy spending on energy, construction, and specialized labor. That backdrop has pushed market-implied odds of another Fed hike toward the high side, and some policymakers are openly entertaining additional tightening if inflation fails to ease. In contrast, other forecasters still see the Fed on hold through this year, with cuts next year as labor data soften and unit labor costs, which recently undershot expectations, point to reduced wage pressure. Treasury yields have dipped across the curve on a mix of risk-off flows and anticipation around jobs data, and so far a 10-year yield near 4.65% has not derailed equity momentum. Globally, the rate picture is also shifting. Persistent inflation in Europe and the UK has markets braced for more tightening from the European Central Bank and potentially the Bank of England, while UK gilts trade with a visible political risk premium and long yields around 6%. In Japan, the central bank is signaling a move away from ultra-loose policy, with a June hike under discussion and some officials considering multiple moves that could take the policy rate toward 1%. All of this is happening as governments issue record amounts of debt, and the AI Capex boom creates a long-duration demand for capital that can push term premia higher, even though liability-driven investors still face a structural shortage of long-dated assets. Rates are now highly sensitive to oil. Recent patterns show U.S. yields and the dollar rising with crude, while equities move inversely. For allocators, the focus is on upcoming inflation prints, labor data, and central bank signals, alongside the oil path that could easily tilt the balance between renewed hikes and eventual easing. Credit markets still look strong on the surface, but the cracks are widening beneath. Investment-grade supply has already surpassed $1 trillion in record time, reflecting deep and liquid U.S. capital markets and a willingness by corporates to relever into robust demand. Spreads remain tight, and some asset managers argue that high-yield bonds offer limited compensation compared with equities, especially given where we are in the cycle. More cautious voices warn that a sustained default cycle is underway. They point to thin spreads, a heavy maturity wall, and riskier structures used to finance leverage buyouts and AI infrastructure as reasons why loss severity could be higher this time. In private markets, the rise of zero-coupon and payment-in-kind debt is also seen as a signal that some borrowers are struggling to cover cash interest out of operating earnings. Private credit vehicles sit at the center of the debate. Several large evergreen funds have capped withdrawals after redemption requests exceeded preset limits, highlighting the mismatch between daily or quarterly liquidity and inherently illiquid assets. At the same time, many of these funds report low leverage, steady loan repayments, and strong floating rate income, and they continue to attract institutional capital, with record fundraising over the past 2 years. Household credit is another stress point. Consumer spending is increasingly funded by savings drawdowns and record-high credit card balances, with delinquencies edging up and spending skewing toward necessities rather than discretionary goods. For allocators, this combination of tight pricing, rising defaults at the margin, and pockets of illiquidity argues for close monitoring of redemption trends, downgrade and default data, and the interaction between consumer balance sheets and corporate earnings, particularly if energy prices rise further. In foreign exchange, the most notable development is how currencies are reflecting both policy divergence and changing risk dynamics. The traditional relationship between the U.S. dollar and equities has evolved, with the dollar now tending to weaken more when stocks rally, suggesting a more classic risk-on behavior than in recent years. This matters because FX is once again a primary transmission channel for monetary policy and commodity shocks into global portfolios. Japan is central to that story. The Bank of Japan is openly considering a quarter-point hike this month, with further increases possible later in the year as it responds to persistent inflation and very low real rates. The yen briefly broke through the psychologically important 160 level against the dollar before firming as markets priced in a higher likelihood of near-term tightening and watched closely for any sign of official intervention. Elsewhere in Asia, the Korean won has weakened to levels not seen since the global financial crisis, pressured by competitive dynamics with the yen, foreign investors selling linked to regulatory constraints, and a cautious approach from the local central bank. These moves underscore how export-oriented, energy-importing economies can be squeezed when both policy expectations and oil prices move against them. Recent patterns show U.S. rates and the dollar moving closely with oil, while equities respond in the opposite direction. So any renewed spike in crude is likely to reverberate quickly through currency markets. For multi-asset allocators, the key is how the yen, the won, and other oil-sensitive currencies react to incoming policy decisions and energy headlines, and whether the dollar strengthens again on equity pullbacks or continues to fade on risk-on days. Commodities, and oil in particular, remain the main macro swing factor. Physical crude markets are tight, with actual barrels reportedly changing hands well above widely quoted benchmark levels, even as screen prices for Brent hover around the high double digits. U.S. strategic and commercial inventories are being drawn down at a rapid pace and could approach uncomfortable lows by midsummer if no diplomatic breakthrough materializes. The geopolitical backdrop amplifies that tension. Uncertainty around the Strait of Hormuz, stalled negotiations involving Iran, and intermittent attacks in the region are all feeding anxiety about future supply routes. There is even discussion that if inventories are exhausted and conflicts drag on, Washington could consider restricting oil exports, a step that would tighten global supply and export volatility into broader risk assets. There are offsets. Higher output from producers such as Saudi Arabia, the United Arab Emirates, the U.S., and Venezuela, alongside softer demand from China, is helping to cap the immediate upside. Even so, earnings upgrades in energy-sensitive areas like retail and autos look optimistic relative to the risk of sustained high fuel costs, suggesting some sectors may be underpricing the energy channel to inflation and growth. Gold sits quietly in the background. It remains underowned as attention and capital chase AI-related equities, but it could regain prominence as a diversifier if growth slows or geopolitical shocks intensify. Some allocators are already using energy equities and commodities as a source of funds, on the view that current price spikes are more about temporary supply disruption than long-term scarcity. The evolution of inventories, Middle East diplomacy, and any renewed interest in gold will be crucial signposts for commodity risk premia. Stepping back, the cross-asset picture is defined by an AI-driven Capex boom and an uneasy truce between growth and inflation. Equities still draw strength from powerful earnings in technology and a broadening set of sectors and regions, but valuations, narrow leadership, and an intense IPO pipeline leave little margin for disappointment. Rates are being pulled higher by stubborn inflation, heavy issuance, and long-dated capital needs, even as softer labor and wage data offer glimpses of disinflation. Credit continues to fund the expansion, yet tight spreads, rising default concerns, and pockets of illiquidity in private vehicles argue for close monitoring of where risk is truly concentrated. In currencies, policy divergence and oil sensitivity place the yen, the won, and the dollar at the heart of global transmission, while commodities, led by tight oil and a neglected gold market, remain the wild cards that could reprice inflation premia and risk assets quickly. Over the coming weeks, the key signposts will be AI-related earnings revisions, the behavior of oil inventories and Middle East risk, and how central banks navigate the trade-off between persistent inflation and gradually cooling growth. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.